Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is a special edition where we are going to be focusing on the new IPO space. Anthem Biosciences has entered into the day 2 of its IPO. It's got fully subscribed by entering into day 2. Remember, it's a 3,395 odd crore rupees IPO. This is an entirely offer for sale. The price band for the IPO is 540 to 570 rupees per share. The company operates as an innovation-driven and fully integrated contract, research, development and manufacturing organization, that's CRDMO, that provides end-to-end services across the drug development life cycle for both small molecules and also biologics. Now, it generates revenue from the manufacturing and the sale of specialty ingredients as well. To detail for us the company's vision going forward, its growth plans and the outline going forward, I'm now joined by the top management of the company, Mr. Ajay Bhardwaj. He's the Chairman, Managing Director and the CEO of Anthem Biosciences. He's joining in, and also joining him is Gawir Baig. He's the CFO of Anthem Biosciences. Warm welcome to both of you and thank you so much for your time on Business Today Television. I'm going to be starting off with you, Mr. Bhardwaj, and I want to understand from you, for our larger audiences, if you could explain to us a little bit more about the business that you are in as a CRDMO player. How is your business different from an average pharma company, and how do we understand as to what generates revenue for you, sir?
Yeah, good afternoon to you and your viewers. Yeah, it's important to, I know this is a new age business. CRDMO stands for Contract Research Development and Manufacturing Organization, which means we are contract researchers to global drug discovery companies. The model differs here from other models that are in pharma companies, which you see the Indian pharma company largely are in generics. Now, what we do is we are not in generics at all. We become the contract research developers companies. So this is something which is a new age knowledge business, and we see that this business is going to get bigger and bigger. If you were to take an analogy, I would say we are at a stage where generics business in India was 35 years ago. At that time, people felt that, exporting formulated drugs to the West, it's not going to be an easy ask. But today, Indian pharma companies control 40% or more of the generics market in US and a significant share in Europe as well. Similarly, we have just scratched the surface of contract research. Okay. So we work with companies which are emerging biotechs. These are people who have started with venture capital, with an idea, with intellectual property. There are a few people in the company, but they have money, but they don't have labs. So we become their labs. We offer our services to these emerging biotech to assist them in developing new drugs. So this is our business model, and we've been doing it for now 20 years nearly, and we have come to the market now after having been profitable 19 out of that. Every year that we've been in business, fully operational year, we have made money. So we are an extremely profitable business, and it's a new age business. I mean, I can clarify more, but this should suffice for now.
Yeah, just to add, just about maybe a one line will help. That when you do this drug discovery for the clients or the partnership that you have with global innovators, at what all stages do you earn revenue, sir? Is it after the completion of the drug? What is the life cycle? If you could explain to us.
Yes, Sakshi, very good question. So in the beginning, we start with discovery. Then it moves to drug discovery is a many gated business. At every stage, there have to be approvals from regulators. So in the beginning, when you're discovering, it has to take permission for your animal trials. Then you take permission for phase 1, phase 2, phase 3. And at each stage of this development, we participate. So we are end-to-end supplier of services. So as the product progresses, as the molecule progresses towards commercialization, Anthem is participating in each of those activities. And finally, when it gets commercial, even there, we supply the active ingredient or the API as it's called, but these are novel drugs. These are not generics. So we supply the API or the advanced intermediates that is required by our clients. And generally by that time, emerging biotechs, if you have a successful molecule, very often they get acquired by big pharma. So we end up as commercial suppliers to big pharma. And you'll see in our filing that more than 50% of our business comes from commercial products. These are products that we help discover, and today we sell them in large quantities to global pharma majors.
Okay, that's a very important point to that you make, and I will circle back to that point and delve a little deeper. Let me just also get Mr. Baig here into the conversation. Mr. Baig, if you could highlight for us what helped you take a decision that, okay, we are going for a complete OFS. This is one aspect that most of the analysts have highlighted, as a key concern. Why would you not also have some value creation that fresh retail holders or shareholders can also participate in?
Thanks, Sakshi, for asking this question. See, as a company, over the course of this last 19 years, we've been generating cash. We've been a profitable company with very good quality fundamentals from a profitability metrics point of view, as well as from a capital efficiency metrics point of view. If you look at our performance vis-a-vis our peers, we stand up as the number one when it comes to revenue growth, when it comes to profitability metrics like EBITDA margins, PAT margins, or even the capital efficiency metrics like ROCE, ROE, or asset turnover. So as a cash generating business, we are now in a self-sustaining model where we generate cash, use our cash generated as well as internal accruals for fueling our future expansion, which is what we've been doing by keeping on adding capacities for our Unit 1 facility, Unit 2 facility. Unit 3 is also done, and now we are embarking on a new expansion for Unit 4. As it stands today, as of 31st March 2025, we are sitting with a net cash of 625 crores. And that the breakup of that is close to about 735 crores of cash and cash equivalents and mutual fund investments. And against that, about 109 crores of working capital debt. And even that working capital debt is a fairly low cost debt, what we have right now. So this cash, what we have, will be using it up for future expansion. And hence the requirement of a primary raise coming into the company is not there, because we feel that the cash on the books as well as the cash generation going forward will be able to fuel our future expansion. The deal which is on the table for which we are doing the IPO is also something which is to cater to the minimum requirement from a SEBI point of view to have it as a 10.6% sort of a offer for sale. Mostly it is coming from a private equity investor who had backed us in 2021. We had True North as an investor who came in 2021, so we are giving him a part exit. Otherwise, if you look at it, Ajay, who is the largest shareholder in the organization, the principal shareholder, he's not doing any OFS in this transaction. Okay. We are just bringing the promoter shareholding down from 76.8% to maybe about 74.6% to comply with the regulatory requirement. Otherwise, it's largely our investor shareholders, marketing partners, and a few other employee shareholders who are doing this OFS. Plus, we've also given a fairly large, broad-based ESOP pool for our employees. We've covered 40% of our employees under the ESOP pool. So it's sort of a situation where we can provide some wealth creating opportunities for our employees as well. And mind you, no one from the ESOP pool is selling also. So this OFS is largely for the investors who have backed us in 2021, and we are providing them a part exit.
Okay. Mr. Baig, another key concern is that you've priced the IPO pretty aggressively when we compare it with the peers as well. I mean, your price to earnings ratio stands at a multiple of up to 71. And when we compare with the peers, it's anywhere between 51 to about 80 odd levels. How would you really look at that aspect?
So Sakshi, with respect to pricing, we have gone fairly from the advice that we have received from the BRLMs who had done this entire book building exercise for us. They've taken us to almost 100 plus investors, institutional investors during our roadshows. And the pricing which was set, we also got a very credible marquee investors on our anchor book as well. So I think I will not comment anything on the pricing because what's coming out with respect to the anchor book, with respect to some marquee investors coming in, and also with respect to the current subscription that we are seeing right now, it's a good pricing which has been set in by our BRLMs. And mind you, the promoters are also not doing any large secondary on this transaction. So Ajay, as I mentioned, is not even selling a single share. So I think the pricing is apt with respect to the performance of our
Yeah.
numbers. Definitely stack up vis-a-vis our peers.
Okay. Coming back to Mr. Bharadwaj, you were making a point when you did talk about that, when your clients are small biotech firms, they can also often get acquired with the big pharma companies. That's where I want to come in. Is there any risk of, customer stickiness? When it comes to your small biotech firms and when they're acquired by big pharma, will they continue to, have your partnership with you as well, is what I want to understand.
Yeah. So, a fair question. It is actually our experience has been that has been 100% they have continued,
Okay.
and the stickiness of the customers actually is more than you would see in other pharma businesses. Think about it. It takes 8 to 10 years to discover a new drug, and you are it's and most of these are de novo in the sense they are this first time anybody is making these molecules. And as a developer, as a researcher, developer, and then manufacturer, we have been involved at every stage. So we know most about the molecule than getting a new player, a new supplier involved with it. So generally, if you don't give your customers any compelling reasons to, not work with you, people will stay with you, and that has been our experience. We have found that even when the when the product or the company gets acquired, we continue to supply to the new owners, be it mid pharma or large pharma. And see the average age of our relationship, if you see in our document, is 11 and a half years. So we have a very, very sticky relationship with customers. So,
Okay.
and many of these people we have been working with now, who are our big pharma customers now, we've been working with them for almost the entire life of the company. So I think the relationships are extremely sticky here.
Okay. Okay. So another, aspect that all of us are wondering is that, about 50% or little more actually comes in from a concentrated geography for you when it comes to the revenue concentration. And when it also comes to clients, I think most of your clients, I think about top 5 would contribute about 70% to the revenue. That's what we are given to understand. Is that a risk, or is that would you say that it is a positive for you?
Again, it's a positive. See, the geographies is US, Europe, and Japan. Principally, our business comes from these three geographies. And these are global companies operate in all the geographies. So when you have a successful commercial product, it generally tends to be registered across the globe. We have one product which is a blockbuster, which is registered in more than 140 countries. So this concentration is good. It's in no way a negative, and it's not so. When we are in our customers' files, they would like to keep us there because we also tend to be the biggest supplier of it, right? And this has been our experience that even when companies get acquired, the new owners will almost always, and what we have found so far, 100%, they stick with us as the main vendor.
Okay. One more thing, you just pointed out about blockbuster drug. Could you tell us what all have been the blockbuster drugs that we know of and where you may have participated, to get a little more color to all our viewers to understand?
Yeah, first, the definition of a blockbuster drug is a drug which has a final sale of $1 billion or more globally. So, out of the molecules that we develop, and of course, this only it happens over time only. 4 of these 10 commercial products that we supply our products to are blockbuster now. So they are some of them are massive successes. Some are on their way to becoming $1 billion drugs. So it's a journey. The important thing to remember is that the patent cliff for these products is way off. So among the products that we make, the first patent that expires might be in 2032, and many more beyond that. So as I said, this business differs. Fundamentally, this business differs from generics, and the way it is structured is that you would continue to be in the supply chain of your customers because you are in their filing. And when you talk about blockbuster drugs, which means these are very fast growth molecules. In fact, the molecules that we service that we are providing products for, they have an average CAGR of over 17%. That is projected in the next 10 years. So we feel that we are in a very comfortable place in terms of supply of materials to these.
Okay, got that. Mr. Baig, coming to you, let's talk about a little bit on the financials. What we've seen is that you were steady about 35% odd top line growth. You're also reporting a margins of around 36% odd. Tell us what is the kind of growth trajectory we can expect from you going forward? Are you holding on to the same performance? Will you be able to replicate this in future as well? And is there also scope for further improvement?
So Sakshi, with respect to our growth projections, may not be able to give any forward-looking guidance over here, but I'll just talk about the ingredients of growth that we have put in. As we have talked about that, the drug development cycle is a 8 to 10 year cycle. So what we are seeing as successful commercial molecules right now is something what we have worked over the last 8 to 10 years. So right now, our pipeline has to be robust enough that we are targeting for molecules which could give us revenues going forward in the future. So along with this 10 commercial molecules that we supply, we are working on 150 other programs, out of which there are 16 programs catering to 10 late phase molecules, and late phase we are defining as something which has been in phase 3 or it has been filed. So those are sizable molecules which could give us good revenue potential going forward if they clear from phase 3 to commercial. Along with that, we are working on about 130 to 140 programs which are in early stage. Early stage is what we're defining as phase 1, phase 2, as well as preclinical. So some of these programs might succeed, some of these might fail, but we will also get some good revenue growth as these programs moves from phase 1 to phase 2 or phase 2 to phase 3. So in our business, we have to have multiple shots on the goal, which is where we need to have a robust pipeline so that what we have replicated in the past of 10 commercial molecules could be something what we could aspire to do going forward in the future. So this is one ingredient of our growth. The second ingredient of our growth is, are we looking at investing on capacity? Because in our business, the research has to lead to development, development has to lead to manufacturing, and manufacturing is the place where the growth comes in. So we've been investing on capacity. We've been expanding our Unit 2 facility where we are adding about 50% additional capacity. That has, part of it has gone on stream in April 2025 and part will get on stream in this year 2025. We have added a new facility which is Unit 3. It's a completely greenfield facility. It has been commissioned over phases from 2024 and 2025, should get completed in this year, in this calendar year 2025. There is a 30-acre land parcel which was earmarked for Unit 4, where we have started work in June 2025 itself. It's again a greenfield project, so it will take some time to build, and close to about 2 to 2.5 years will take time to set up that facility. Plus, we have a land parcel for Unit 5. So the second ingredient of growth is capacity addition, and we have been embarking on this capacity additions for catering to our customers. So both are there to help us in terms of getting growth going forward in the future. Historically, we have done close to about 24% CAGR over the last 5 years, and the margins have been steady at about 36 to 37%, with EBITDA and PAT around 23 to 24%. I think we are in a comfortable space where we should be looking at aspiring to deliver on these margins.
And if I may add, the third ingredient is our specialty ingredients. So we have products which actually, in a very big way, they are products that our own products which are not generics, and they do not compete with what we do for our customers. There are things like probiotics, enzymes, vitamin analogs. These are areas where they fall in the category of wellness, and this is another very fast growth area. This is largely focused at India and ROW. And here also we use our innovation and technology to we don't make Me Too products. These are products where Anthem tends to be one of the very few suppliers in the world, which we have developed with our own technology. So even in this, we command very strong margins, and it has tremendous high growth potential. And we are able to therefore sweat our assets more than any of our peers. And you will see this in our numbers. We have some of the best asset turns because we have our own product line where we are able to, while we wait for our commercialized products or other products to move to commercialization, while we wait for them to become big, we are able to sweat our assets with our specialty ingredients, which gives us a lot of elbow room and a lot of wiggle room to grow.
Okay, on your specialty ingredients, I think it's 18% of your total revenue mix, sir. Where do you see that growing to?
I think historically we've been around that 22%. March 25 has been around 18.35%. I think broadly we would be in that same zip code of 18 to 22% going forward as well. Broadly the same trajectory for specialty ingredients, and the large portion of our revenue still will continue to be CRD.
Okay. Mr. Bhardwaj, you also have some cash on your books of upwards of 600 and 650 odd crore rupees. What is the plan, to deploy this going forward from here? Since Mr. Baig also highlighted that consistent building of capacity is going to be your focus, how are you looking to also probably fund those capacities going forward?
So far, we've been on a self-sustaining mode. We have built the business by funding it internally. Okay. We have very small working capital debt on our books, but largely we have a lot of cash invested in mutual funds and bank deposits. So this is one of the, we will be able to fund our future plans with this. And also, if there are any other opportunities which show up, we'll look at them. But because we are in a continuous cash generation mode, and if we are still we just finished the first quarter of this year, we would expect a significant amount of cash generation this year too, which will add to the kitty that we already have. So we are very well funded, and one of the reasons for doing this IPO is that we have to give a liquidity event to our private equity and to some of the people who have been with the company for a long time, and that's the reason. And I'm not selling anything.
Okay, got that. Well, Mr. Bhardwaj and Mr. Baig, thank you so much. It was great to speak to you about the company. All the very best to you for the IPO. There's one more day to go, and of course the upcoming listing as well. And we'll catch you soon around the earnings as well, very soon, to understand a little bit more as to how your growth plans are going forward from here. Thank you so much. Appreciate your time.
Thanks a lot.
Thank you, Sakshi. Bye-bye.
All right, viewers, we wrap it up on that note. For Anthem Biosciences, I hope this has given you enough and more clarity as to how the management really feels about their business, the growth opportunities that exist for them, and what are their focus areas going to be as well. Stay tuned with us on Business Today Television, as up next our market coverage continues, and I'll be, of course, seeing you at the closing edition at 3 p.m. Stay tuned.
We're dealing with other countries and certain countries.